Hey there, and welcome to today's Explainer. We constantly hear this idea that building lasting wealth is just, well, this mystical secret reserved for the ultra-rich, right? But today, we're looking at a strategy that's so incredibly simple, honestly, it's so seemingly boring, that most people just completely overlook it. But as we'll see as we unpack our source material today, this straightforward approach can literally transform your financial future.
Think about this for a second. What if one tiny, almost unnoticeable daily choice could completely dictate whether you retire wealthy or totally broke? We've all been conditioned to picture wealth as, Wall Street traders making million-dollar deals, tech entrepreneurs hitting it big, or lottery winners. We buy into this massive myth that you absolutely need a trust fund, a massive salary, or high-level connections to get ahead. But those dramatic headlines? They just dominate the news because they're the exception, not the rule. The real secret to building wealth? It actually isn't glamorous at all.
$1,000. According to recent financial surveys, the shocking reality is that the majority of Americans actually can't access even this amount for an emergency. And here's the absolute kicker. This isn't just about folks working minimum wage jobs. No, this statistic includes people with decent jobs, college degrees, and what look like totally comfortable middle-class lifestyles. They are living so close to the edge that literally just a minor car repair could completely derail their entire financial life.
What we're looking at here is what's known as the earn and spend trap. The modern middle class is often living an incredibly fragile reality. People get trapped in this endless hamster wheel where they earn money, spend it all, and just repeat the process without ever building any meaningful wealth. Now, they might look wealthy on the surface, right? Trendy clothes, the absolute latest gadgets, brand new cars, but underneath all of that consumption lies a really frightening truth. They are secretly broke. But what if there was a way to escape this trap?
Section 1. Finding your first 100. Let's look at a simple shift.
To actually escape that earn and spend trap, we just need to shift a tiny amount of money from consumption over to wealth building. 60%. Get this. If you can develop the discipline to consistently save just $100 every single month, you will instantly leap ahead of more than 60% of your peers. That simple act alone puts you in a better financial position than the vast majority of people around you. And it's not because $100 is this massive, impossible amount of money. It's simply because most people never develop the basic discipline to consistently save anything at all.
So the really crucial question here is, how do you actually find that extra $100 each month, especially if you already feel like you're stretched thin and living paycheck to paycheck? Well, there are two simultaneous approaches that successful people use to free up that money, and they do it without making drastic, unsustainable cuts to their lifestyle. Basically, you can either reduce your fixed expenses or you can increase your income. Let's break down exactly how you can deploy both of these strategies starting today. Okay, on the expense side, you want to start by targeting your recurring monthly bills. You see, companies heavily rely on customer inertia. They know you probably aren't going to call up and negotiate your insurance premiums or your cell phone bill. But honestly, just a few hours of research can easily save you $50 to $100 right there. Next up, audit your subscriptions. Cancel those streaming platforms, the gym memberships you haven't used since January, and that software you totally forgot about. Now, on the income side, the modern economy gives us more opportunities than ever before. You can freelance using the skills you already have, start a small side business, or just pick up a few hours of strategic part-time work. At the end of the day, the specific method you choose matters way less than your commitment to actually taking action.
Section 2. The power of compound growth. Building your wealth machine. Okay, so once you've found that $100 a month, your money actually transforms into a wealth-generating machine. Let's map this out on a timeline. When you put that $100 to work in the stock market, you are stepping into a totally different financial universe. Just look at year 10. Assuming reasonable market returns, your monthly contributions of $100 add up to $12,000 straight out of your pocket. But your account will have grown to approximately $18,000. That extra $6,000? That is literally your money earning money for you. It's a nice milestone for sure. But here is where so many people make a critical mistake. They look at that $6,000, think to themselves, well, that's not exactly life-changing, and they quit. They're completely missing the exponential picture.
Instead of just 10 years, let's stretch this out and look at a 40-year career, assuming a pretty conservative 8% annual return, which, by the way, is actually lower than the historical average of the S&P 500. Over 4 decades, your total out-of-pocket contribution is $48,000, but the total value of your portfolio, it absolutely explodes to over $350,000.
The sheer scale of this difference is staggering. Just notice that the actual amount you physically worked for is just $48,000. But the vast majority of that $350,000 ending balance, over $302,000 of it, didn't come from your physical labor at all. It came from your money working tirelessly for you while you slept, while you ate, and while you went on vacation.
Let's break that down even further. Only 15% of your total wealth actually came from your own pocket. A massive 85% came directly from compound growth. Guys, this is the fundamental difference between people who build lasting wealth and people who just struggle financially forever. Wealthy people deeply understand that there is a hard, physical limit to how many hours you can actually work in a given day, but there are virtually no limits to how much your money can earn for you over time through the magic of compounding.
It's a mathematical reality that's so awe-inspiring that Albert Einstein allegedly referred to compound interest as the eighth wonder of the world. And you know, whether he actually said it or not, the core sentiment is absolutely true. When you combine simple consistency with enough time, the results are nothing short of miraculous.
And as your portfolio scales up, the momentum shifts completely. In those early years, the returns can definitely seem kind of insignificant. I mean, a 10% return on $5,000 is just $500. You might reasonably think, I could just work a few extra overtime hours for that. But as your balance grows, those percentages translate into massive, massive dollar amounts. When your portfolio hits $300,000, that exact same 10% return is generating $30,000 in a single year. Suddenly, your investments aren't just giving you a little extra pocket money, they're creating substantial wealth that could potentially replace your salary entirely.
Section 3. Automating your wealth machine. How to beat the culture. So the math is completely undeniable, but the hardest part of all this, it's the psychology. It's having the willpower to avoid instant gratification. To survive that cultural pressure to spend, successful investors follow a specific psychological progression. First, you start with that $100 a month. Second, and this is absolutely critical, you set up investment automation. You have to treat that $100 like an essential, non-negotiable bill that simply must be paid. Think of it as paying your future self first. By automating it, you completely remove the monthly temptation to blow it on a flash sale or a quick weekend trip. Third, you watch the monthly growth, which slowly starts to change your mindset. And fourth, you begin to actively optimize your lifestyle so you can invest even more.
Section 4. The Snowball Effect. Accelerated Growth.
When you actually start seeing your net worth improving month after month without logging any extra work hours, you enter what we can call a wealth-building acceleration phase. You really begin to understand the difference between lifestyle inflation and lifestyle optimization. See, most people experience lifestyle inflation. They get a raise, they go buy a nicer car, they get a bonus, they immediately buy a bigger TV. But once you catch the investing bug, you shift to optimization. You start channeling those tax refunds, those raises, and those bonuses straight into your investment accounts to accelerate that snowball. You suddenly realize that a $100 dinner out isn't just $100, it's hundreds of dollars in lost future compound growth.
So the absolutely crucial point here is that the end goal isn't just about having a really high number on a screen somewhere. Having this growing pool of capital buys you options. It gives you the incredible freedom to take calculated risks that most people simply cannot afford to take. You can take a risk on a career move with a smaller company that offers better long-term growth. You finally have the capital to start that dream business. You can jump on real estate opportunities. But most importantly, you gain total freedom from the sheer panic of living paycheck to paycheck. Ultimately, you are buying your own independence.
Which leaves us with this final, really important thought. Your biggest asset in all of this isn't your job, and it certainly isn't the starting amount of money you have. Your absolute biggest asset is time. The difference between starting at age 25 versus age 35 isn't just 10 years of standard contributions, it's the permanent loss of 10 years of massive exponential compound growth that you can never ever recover. The math is proven, the strategy absolutely works, and millions of people have used this exact, boring approach to build incredible wealth. The best time to start was 20 years ago. So, will you take your first step today?